In this video, I'm going to go over the sale of a non-current asset. So in this example, the company sold equipment that cost $200,000. So they have the cost of the asset on the books at $200,000, and they've depreciated over the last 3 years using straight line. So the accumulated depreciation balance is equal to 3 years, because it's the same each year, times, let's do the annual depreciation calculation, which is your cost, 200,000, minus the salvage value or residual value, divided by its estimated useful life of 3 years. So it has 150,000 in its accumulated depreciation at the time of this sale. So the net book value you can see is 50,000, the cost minus your accumulated depreciation. And by design, that's what it was intended to have as its salvage value at the end of the 3rd year. But now what's happening is we're selling it for 45,000. So we're getting debit cash for 45,000. The 45,000 compared to the book value, if you look at the book value of 50,000, it's 5,000 less. So we're not getting as much cash as the books are saying the assets is supposedly worth. Now, as far as we now have to get the equipment off our books, I'm going to go ahead and credit equipment, and that'll be for that 200,000. So we're going to credit equipment. That gets it off the books. And then we also have to remove its related depreciation, accumulated depreciation, excuse me. And we will debit accumulated depreciation so that it'll have a 0 balance, doing the opposite of what's in there. So we post that to our ledger. And you'll see that our debits are less than our credits. So we're short 5,000 on the debit side. So in other words, this minus the sum of our two debits of 45 and 150 gives us a loss, because the loss is, actually let me record the right account title, which is gain loss on on sale of equipment, or whatever the asset may be. So we would go over to here and post this. It's going on the debit side because losses decrease shareholders' equity, and we are losing, in a sense, 5,000 as a result of this sale. So again, you record the accumulated depreciation at the point of the sale, so you have its book value or net book value, which is the difference, and compare it to your cash. If the cash is less than the net book value, you have a loss. Now, if it had been where it was greater, you would be debiting your cash for more than the net book value, so you would have a credit over here, and the credit would go on the right side of the account. So that's how you record the sale.